Obviously, don't get me wrong, Melbourne has an awful government. They are socialist, they are shit, they don't know what they're doing, I think they should literally be arrested for what they've done to the state. Honestly, I do, because they're the worst government I think I've seen in living Australian history, literally the worst government. Now, a lot of Melburnians will say that, yes, the state has a lot of debt. Yes, the economy is doing badly. And don't get me wrong, yes, we have very bad governments in the moment. And don't get me wrong, yeah, that may continue, no doubt. But really what we need to look at is the actual income of the state and what's actually going on there. So this is between 2019 and 2024. So this is the median weekly earnings in people's main job. Now, that's by state and territory. So you'll see here the highest earners to the lowest earners. So you see Victoria right there. And you'll see just highlighted in the bottom here of the state capitals, Perth had the highest weekly earnings of $1,500 per week, followed by Melbourne and Sydney at $1,450 and $1,416 per week. Now, something you need to know about this is Perth is very high, mainly because of mining and it's mainly resources. So Perth alone, don't get me wrong, I do own in Perth, but it is very resource dependent. So there is inherent risks with buying there. Sydney and Melbourne, the difference between Sydney and Melbourne, Sydney siders do earn more than Melburnians in general, but this is what this is doing is it's actually comparing the whole market here. It's not actually saying whether a person works full-time or part-time or it's just a casual job. They're just saying how much they earn per week. But regardless, what really you need to look at here is Melbourne's still actually quite high there. It's very high because Sydney and Melbourne are the most diversified cities in terms of employment by far in Australia, by a country mile. Now, they're the main two ones you want to look at long-term, to be honest, and it's because of the diversified industry there and the international demand of the industry there, right? Now, if you look at this is an ABS actual graph here, and you look at the 2019 actual number and then the 2024 number. Now, mind you, this is despite Melbourne having its worst economic performance pretty much since the early 90s, right? Pretty much since then. Now, if you look at the growth rate of that, it's higher than anywhere in the country by a long way. It's quite significantly higher than anywhere in the country. So yes, Perth did grow from $1,200 to $1,500, but Melbourne grew, so that's $300, but Melbourne grew from $1,073 to $1,400. Now, that's what, $327 there. Now, you got to think as well, it started from a lower base, so the growth rate is significantly high. In literally its worst financial time, pretty much since the early 90s. Now, for people that don't know, the early 90s, Melbourne had a lot of issues as well. Very similar to today, it had high debt, quite also a bad, I'd say, state economy, and it still did between literally the late 90s and early 2000s. It did like more than 100% growth in those times. By the time, it hit literally like 2008 to 2010 really. It's something ridiculous. It had done like 150% since 1997, 1998 in like 12 years or something like that. So this is what I'm talking about in terms of markets being underpriced but despite having quite good numbers. So people aren't seeing this. Yes, you have a terrible government. I'm not saying you don't. Yes, you have a lot of state debt, but really that will turn around. Victoria will not be the worst one forever. Yes, it might be for maybe now and a couple more years, but it will turn around, and Melbourne's still Melbourne at the end of the day. That's why you get numbers like this, despite everything that's going on. Now, furthermore, on top of this too, what you need to know is the future undersupply of Melbourne is one of the highest in the country. So this is Matusik data going right up between 2025 and also 2030. So this is just showing you the undersupply. And the one you really need to know is, so the four columns you have here is, first of all, the supply required. Second of all, the supply that's getting built in. Third column then is the number of undersupply, and the fourth one is most important, that's the percentage of undersupply. So you'll see clearly alone here, the ones that are most undersupplied is the ACT, Northern Territory, Tassie, New South Wales, and Victoria. So really what you need to know here is that if you want to know where the market cycles are at, Melbourne is probably at the best point of its market cycle now. It probably was a couple of months ago, to be honest. You had even better buys then because it was already off its bottom. But yes, don't get me wrong, the two most diversified states are New South Wales and Victoria by a mile. Yes, New South Wales is more undersupplied slightly than Melbourne, but New South Wales, the difference you'll have is that you've got quite a large Sydney Basin region in New South Wales, so it's right from Newcastle right down to pretty much Shell Harbour. That's your Sydney Basin region, so that would be included in this. And most of the undersupply will come from that, don't get me wrong, but it's spreading out across Sydney. Melbourne is predominantly all Melbourne, where everyone lives, and all this undersupply is coming from. And it's also a better point of the market cycle. It's also a lot cheaper compared to Sydney. It also has had better growth in terms of income despite being in a bad position. So a bit of policy change and a bit of, should I say, better governance, which they might do, will change that, I think, immediately. Despite that, with how cheap it is anyway, it's going to grow. It's just how things are. And also with interest rates coming down, it will grow as well, regardless of what decisions are made. I can tell you that right now. So that's another reason you're going to see growth in Melbourne. Now, furthermore, a thing you need to know too here is that the resistance trend line has actually broken. So for people, a lot of people that I work with will understand what I'm saying when I'm talking about this, but a resistance trend line is basically, it's kind of like your candlestick approach that I'm talking about here. So a lot of your Forex traders, a lot of your stock traders, a lot of your precious metals traders, your exchange rate traders will know what I'm talking about. A lot of my engineering clients understand this very well. But for people that don't understand this, generally markets don't go up in a perfect linear fashion if you look at it on a small molecular basis. So I'm saying you're looking at it on a weekly, a monthly basis, so a small basis. So what you'll get is in a day, basically a market, should I say, it might jump up 2%. It might have a quick growth rate in the first, couple of, maybe hours. It might go up 2%, then down 1.5%, then up 2% again, then down 1.75%. In the day, let's say it ends at 2% or something like that. What a resistance trend line is it's when basically when a market is going up, generally your ups are larger than your downs, and it continues that way. When it goes down, your actual candle that goes down is larger than the one that bounces back up, and it continues that way, so the market goes down. Now, when it levels out, what happens is there's actually resistance to going up or down. So Melbourne obviously went down till literally later last year, and earlier this year it broke it. So what you'll see here is on the left side here of the actual, this is the daily laid back indices on CoreLogic. You can see this publicly. You'll see here that it was going down, and then basically it petered out. So what happened there was the resistance trend line had actually broken. So yes, it doesn't happen the same as stocks, as in you look at it by the hourly or the daily basis. In property, how you look at it is you look at it over generally a couple of weeks. And what happened there is the actual market started to, instead of going down, let's say 0.05% on a daily basis and bouncing back up 0.01% on a daily basis, what happened was it would bounce down 0.02, then bounce back up 0.02, or vice versa, or very similar numbers. So the kind of candle approach and the actual resistance actually broke. And you can see now, because it's broken, what has happened is it started to go up. And that is very common in markets, and it works in a longer time period in property, don't get me wrong, as I said. However, as I said in the past, that is exactly what you want to see happen. That's the best time to buy. So the best time to buy, as I said to everyone, was late last year. And probably to the turn of the new year this year. That's when it was starting to break. And I was telling everyone to absolutely pile in now. If you look at my episode on the property clock, you'll see exactly what I was saying, and you'll see me saying it is going to turn immediately. You can fact check me on that. Look at my I think it's my October property clock update, and then go straight into my January, then also my April, and then you'll see my most recent one in July. You'll see exactly what I was talking about. I said this was happening to everyone. I said it's shifting, it's changing. So this is where I was getting that data from, and it was also on the ground. So this data, in my opinion, CoreLogic is only accurate to 3 months. Real estate's accurate to 12. On the ground is accurate to today. So I wasn't talking rubbish to people. I was telling you the truth of what's going to happen. And furthermore, this is a previous slide that I used in the past, but this is exactly what's going to happen in Melbourne as well. So you can see over the long term here, you first of all got your downturn and stagnation. You can see here, and you got periods of that consistently. So 92 to 97, which is the most similar one to today. 2007 to 2012, a bit of a sort of smaller, should I say, stagnation. And then today is the longest. It's 2017 or 2025. That bottom trend, I think, has broken, and the actual upturn has already started, in my opinion. But you look at the booms, you generally have a major one than a smaller, sharp one. That's generally how the market works. So you had your major one, as I said, between the late 90s and pretty much 2008. So that was ridiculous numbers, and it was like 150% growth, right? Then you had, basically after that, you had your shorter, sharper one between about 2013, 14 and 2017. That was your other, should I say, short, sharp Melbourne one, right? Now, that growth there alone did probably somewhere between 80 and 100%, so smaller and sharper, don't get me wrong. But the one we're in for here, so I've extrapolated, if you look to the far sort of right of the graph here, where 2025 is today, so it's not much above literally 2017. However, we're in for the the next one is the major boom of Melbourne. It's not the minor, it is the major one of Melbourne. It is going to be big, and is going to be sustained for quite a few years. So you'll see there just beyond upturn and boom, I've got 2025 to 2030 question mark. It's because I think this isn't only going to be probably a 5-year upturn and boom. It's probably going to be more than 5 years. The upturn will probably run for a couple, and the boom will probably run for somewhere between 1.5 and 2 years as well in Melbourne. That's what's going to happen. So it's going to be for a very sustained period. So look, if you just want to pause and look at this graph a few times, I recommend you doing it, and then go back to the other things I've shown you. This is showing you exactly what's going to happen in Melbourne. It is the best time to buy. It is so underpriced despite everything that's going on. And we've seen this before. It's no different to what has happened before. So that's what you need to understand in Melbourne.